Hey everyone, and welcome to another edition of the Quantum Mailbag. In this video, we're going to talk about expected value. A lot of questions come up around expected value, and they're usually one or more variations of asking us how to project the value of a stock over time, or how to project the expected value of an option over time. Of course, we have tools to kind of do this, but it's not always clear what they're doing under the covers. So let's dig into a bit of the detail behind the theory behind especially option math that goes into pricing options and what therefore the expected value of them is. So we'll step back by thinking about the expected value of an investment. So in short, the expected value of any given investment is going to be the risk-free rate of return, which is usually measured in terms of the treasury rate for that term. Now, the reason for that is fairly obvious. If the consensus rate were higher than that, then there's always going to be opportunity for arbitrage. So if the risk-free rate of return is 5% and there is another guaranteed rate of return at 6%, everybody would be shorting the 5% and going long the 6% return. And it would eventually find a new equilibrium. So as a result, we don't end up seeing that. And that's why the treasury rate tends to be so important, is that it becomes the benchmark for what the expected rate of return is that everything gets measured against, as well as its impact on things like loans and so forth, which is in and of itself a reflection of the cost of borrowing money. So when you think about all these different things that go into it, just imagine that any given investment should be expected to return the risk-free rate. Now, it doesn't always work out that way, and we have historical data that shows that, but it's also a little bit skewed, so you have to kind of take it with a grain of salt. So, in practice, most investment modalities, at least the ones that still exist, will deliver a higher rate of return. And the reason for that is that the investment methods that don't work usually get dismissed by everybody because they're either Ponzi schemes or some kind of other scam or some kind of money sinkhole. And so those things don't last. People don't invest in them, so they go away. But you will see things like the stock market, where there is actually an argument for why there's an increasing amount of value that comes out of it every year, and why therefore investing in it can give you a positive return over time. Now, when we think about the expected price of a stock, the expected price we'll call the forward price, which means the price that the stock is expected to trade at a time in the future. And there's two factors that really go into this. The first one, of course, well, besides the current price, is you want to take the risk-free rate and assume that the stock is going to appreciate by the value of that risk-free rate. Now, there's a little bit of a caveat here, which is that you also have to extract dividends from that. And so what you want to do is you want to say, take the price, the quick back of the napkin is take the price, add in the return from the risk-free rate, and then subtract dividends, and that will give you a good idea of what it is. So if we take a $100 stock with a 5% interest rate and $1 in dividends, and we're looking 1 year out, we would say over that year, the stock's going to return about 5% on its own. We're going to take that dollar dividend out, we get to $1.04. This isn't a perfect analysis because technically there's other things we should deal with. For example, the rate's continuous, so you won't just take the 5%. Also, you should discount for the cash flow of the dividends as well, because that dollar dividend that's being given out a year from now isn't worth that today. It's worth whatever the risk-free rate is less that. So it's actually worth less than $1 because it's worth some amount of money in company stock that will appreciate to $1 over the next year, meaning that today's company value is more than $99 ex dividend. But again, you don't really generally want to do this by hand. Tools like Quantya exist purely for that. We do all the work under the covers. You don't have to worry about it. So, stock set aside, what's the expected value of an option? And options are interesting because they are derivatives. And so they don't really have prices that they themselves are worth, especially not when you look at expiration. When you get to expiration, they are worth their intrinsic value, plus a little bit of liquidity cost in order to be able to transact. And that's if they're worth anything. More often than not, options expire worthless. So we can think of an option's value today as being the sum of all the weighted outcome scenarios, meaning that if you said there's a 10% probability it closes at 100, and a 10% probability at 110, and 5% at 115, and you went all the way up, you'd be able to calculate what the value of that option should be in expected value, do discounted cash flow against the interest rates, like basically discount the interest rate out of it for the investment for how much money it's worth today. And that's kind of what's happening, over 2 million options that trade every day, millions of times a day. So We do have a volatility video that goes into details around the math underneath that. Definitely check it out if you get a chance. It should cover most of the fundamentals and explain sort of why you want the tools to do this for you. But let's get into some of the ideas behind the probabilities, because they're all generally generated based on at-the-money options. So if you're looking at a term that is an expiration date, which is ideal, then you have a pretty good idea of exactly what the market expects the price of the stock to do between now and then. And this factors in all the other stuff like the dividends and everything else, because the option prices are static numbers as strikes. And so therefore you know exactly what the market feels like the end price is. You don't have to figure out how it got there necessarily. But with the implied volatility, you can do things like chart stuff that gives you a better visual view of what it's going to look like for the expected outcomes. Here we've got two lines. The blue line tells you it's a cumulative function, so it tells you the probability that the stock will close at or below a given price. And so as you can see, it just accumulates up to about 100%. It approaches that as you get to deep out of the money for calls. And then there's also the implied distribution, which is an orange here, which gives you an idea of the relative likelihood of any given closing point based on the implied volatility. Now, there's a ton of different scenarios that come into play around high volatility events, things like earnings announcements, etc., where this doesn't really do a perfect reflection. For example, after earnings, it's very unlikely that a stock closes the next day at exactly where it had been. But this is the best distribution we have for the nature of the math we have today. So the great thing about the option space is it means that as an investor, there's a lot of opportunities to use the existing math infrastructure that everything's based on and then disagree with it in a way that will make you profit. Now, let's get into the idea of how, under ordinary circumstances, you can deal with option mispricing, because it does happen. I mean, most options are actually mispriced. I mean, if you think about statistically, we're using an at-the-money implied volatility to generate a distribution. That's the probability. But each option has its own implied volatility. Everything trades at its own bid-ask spread. Therefore, from that, you calculate and you extract an implied volatility from it. So implied volatility isn't always something that you put into a pricing model to figure out what you'll pay. A lot of times there's a price for a strike, and speculators or people looking for insurance for downturns and so forth, they will just pay what the price is and potentially move that price upwards by buying options at a given location. So keep in mind that happens, and therefore what we end up seeing is usually implied volatility is lowest at the money, and it will increase as it separates from the money, as you get either further above or further below. And this is known as an implied volatility skew, or a smile and smirk and so on, just depending on the shape of it. But it shows that like at the money, you're looking at the lowest volatility, and then as it goes up in either direction, it gets higher, which is kind of interesting because it means that each one of those options is priced for a different range of expectations. So if you took two different options expiring the same week, both, let's say calls, both one in the money, one out of the money, or both at, let's say both in the money, they're going to probably have different implied volatilities, which means that everything about them is the same when it comes down to the pricing factors. Like it's the same underlying stock, right? So that's going to be identical. It's the same time to expiration, the same dividend, same interest rate. It's just the stochastic modeling of the implied distribution is what really factors in as to whether or not one of them is going to be worth more than the other. So there's opportunity there to make money, because if you find places where there's overpriced options and you sell them in favor of buying ones that are clearly underpriced, then that should work out for you. Now, of course, you're going to want to hedge out Greeks. If you can go out there and you just keep buying options, or you keep selling options, or you keep staying with puts or calls or what have you, you could end up with a lopsided book where something can go in the wrong direction with any of those pricing factors and you can just get run over. But you can actually go out there and you can sell the higher priced or the higher vol options in favor of buying lower vol. And it can be anywhere on the surface. You can do short-term, long-term, etc. And the Greeks will help you. Now, they won't do everything for you, and they're not a perfect system, but they will help you understand where the risk you have is, whether it's for volatility, whether it's for directional movement, whether it's for interest rates. So you'll be able to kind of protect yourself in a certain way. And if you stay on top of it with tools like monitoring and tools like the book management, you'll be able to understand what to expect moving forward. However, big caveat, a lot of times the liquidity costs will eat up that profit. So just because you can see that a volatility for a deep in the money call is double the volatility for an at the money call, the amount of money it actually costs you to get into either of those positions, especially with in the mindset that you're probably going to have to close potentially both of those positions prior to expiration, or even get exercised and pay a fee for that, that can chew into your option profit. So there may not really be an opportunity once you factor all that in. But if you're trading a lot of out of the money options and you're selling a lot of out of the money volatility, you're probably trading with the idea that you can expect expiration. But if the expiration doesn't happen and you sold an option for 1 cent, if you have to buy it back at all to close it, you're going to lose money on that position. So if you have a diversified portfolio in terms of, or diversified book in terms of a variety of different options, long, short, Greeks are balanced, you should be able to eke out a profit as time value sinks away and you retain it. However, there's also convergence, meaning that what might happen over time is that if volatility is too low, then the options that you have that you bought at low volatility will increase in value when volatility goes up, and the ones you have at high volatility will not increase as much, and vice versa. Of course, it's a good idea to do some book practicing before you get into putting real money behind the line, but this is where that opportunity comes up and why expected value plays a role, but isn't something that you should necessarily be exclusively focused on. So, as always, we want to thank you for tuning in, and good luck and good hunting.